Hi, dear Miss Rabiya Khan is here. I hope so you are doing well. Today we will discuss about introduction of accounting. We will cover the topic introduction, importance and objectives of accounting. Bookkeeping, as well as accounting versus bookkeeping. Accounting as a business language. Accounting versus accountancy. Important accounting terms and concepts. Need and importance of accounting. We live in a world where people need things from the day they are born to the day that they die. Some of these needs are physical needs, a need for goods of various sorts, food, clothing, shelter, and so on. Some of them are emotional wants, a need for education, entertainment, or recreation. In satisfying such needs, businessmen perform useful services to their fellow humans. In return, they expect to earn a reasonable reward for their efforts in the form of profits. Cut your coat according to your cloth, so goes the saying. Even a king becomes a pauper, if he fails to exercise economy in his expenditures. In other words, every individual will have to plan his expenditure according to his income. Obviously, the question arises, why is planning necessary? The need for such planning arises as our wants or desires or needs for goods and services are unlimited, while the means, i.e. the income with which to buy such goods and services, are limited. Where, however, goods and services are available for free of cost, i.e. gifts of nature, such as air, water, not in cities, etc., there is no question of economy. But the necessity of economy is undeniable, where goods or services are not available free of cost and their supply is limited. A proper and fair planning of expenditures helps us to ensure proper use of income. Of course, it is true that the quantity of goods or money cannot be increased by making a proper planning. But certainly we can ensure most economic use of goods or money at our disposal. Most of us do some kind of written record of income and expenditures. The idea behind maintaining such records to know the correct position regarding income and expenditure. The need for keeping a record of income and expenditure in a clear and systematic manner has given rise to the subject of bookkeeping. So, the importance of bookkeeping to a business is the same as that fresh air to a man to exist. Without bookkeeping records, a business would meet death, though not instantly, but in a short time. Moreover, if proper books of accounts are not kept in a business, the amount of profit cannot be ascertained and it will not be possible to distribute the profit among the owners of the business. Bookkeeping. Bookkeeping is the art of recording monetary transactions in the books of account in a proper manner. The books of accounts are recorded in such a way as will enable us to ascertain the complete and accurate result in the least possible time with minimum labor and cost. Many authors have defined the terms bookkeeping in different ways. Bookkeeping means the recording of transactions, the record-making phase of accounting. It is only a small part of the field of accounting and probably the simplest part. Meigs, Johnson, and Meigs. Bookkeeping is the recording branch of accounting. Encyclopaedia Britannica. Accounting, a business language. Accounting is a language, a system that communicates information. It is often referred to as the language of the business, although it is just as important in the operation of government agencies, clubs, colleges, and other kinds of organizations. You probably have some idea already of what the term accounting means. It is frequently used in everyday conversation to mean answering for responsibilities. Managers of the business are answerable to the business owners, creditors, labor union, and government agencies, etc. So an accounting system is used to collect, process and report needed data about a business, government units, or other type of associations. Information is usually collected, processed, and reported in financial terms, which simply means that money is the basis of measurement. Many authors defined accounting in different ways. The most accepted is the one given by the American Institute of Certified Public Accounts Committee on terminology accounting to it. Accounting is the art of recording, classifying and summarizing in a significant manners and in terms of money, transactions, and events, which are, in part at least, of a financial character, and interpreting the result therefore. An analysis of the definition will enable us to have a thorough idea of the functions of the accounting. The salient features of the definition are: 1. Connected with a monetary event or transaction. 2. Transactions are processed in different stages. 1. Connected with a monetary event or transaction. Accounting must be in relation to a monetary event or transaction, and the event or transaction must be measurable in terms of money. In other words, no accounting is possible for an event or transaction which is not measurable on terms of money, for example passing an examination, delivering lectures in a meeting, etc. These are events no doubt, but since they are not measurable in terms of money, there is no question of their accounting. 2. Transactions are processed in 3 different stages: recording, classifying, summarizing, interpretations. All the above functions are performed on the basis of certain well-defined and well-coordinated rules and principles. An accountant must be familiar with all these rules and principles. In accounting we will study all these rules and principles. Objectives of accounting. Financial information is necessary in order to run a business in an efficient manner. Reliable information will be available only through keeping proper books of accounts. Proper accounting is essential, if money is to be borrowed for the purpose of business. The lender will only agree to lend money when he is satisfied as to the solvency of the borrower. Information available from books of accounts is the mean of measuring such solvency. Cash in hand can be verified and any defalcation can be detected, if proper books of accounts are maintained. Payments of sales tax and income tax are only possible if books of accounts are maintained. In case of any dispute, books of accounts can be produced in the court of law as a documentary evidence. Government fixes up fair prices, formulates industrial policy, prepare economic plans, decides import-export quotas and does many other functions on the basis of accounting information available from books of accounts. Accounting versus accountancy. The two words accountancy and accounting are often used to mean the same thing. But it is not correct. Accountancy is the main subject, accounting is the one of its branches. The word accountancy is far extensive. For example, the scope of accountancy is far wide and extensive compared to accounting. It covers the entire body of theory and practices, for example, bookkeeping, accounting, costing, auditing, taxation, etc. Bookkeeping versus accounting. The function of bookkeeping is to properly record the financial transactions in books of accounts. But the function of the accounting is more extensive, it has many other functions to do except recording transactions, for example, classifications, summarization, and interpretation of transactions. Thus we see the bookkeeping is confined to recording aspect of accounting, it is a small and the simplest part of accounting. Both represent two different phases of the main subject, accountancy. Bookkeeping is the first stage while accountancy is the final stage. That is why it is said that accounting starts when bookkeeping ends. The function of bookkeeping ends with the recording of transactions in the books of account. But the function of the accounting is to classify the recorded transactions, summarize them, interpret them, collect and communicate necessary information to the management and other interested persons. Then management perform the function on the basis of this information. Apparently, the function of bookkeeping seemed to be less important than accounting, but its necessity can hardly be denied. Important accounting terms and concepts. 1. Business entity. Profit-making organizations are known as business. There are three main types of businesses. Those are selling services, selling goods, or manufacturing goods. A business entity means a profit-making organization. 2. Forms of business organizations. There are three types of organizations that are sole or single proprietorship. The simplest of business organization to organize or operate. It's a single or sole proprietorship means single owner business. Partnership. The ownership is divided into two or more persons who agrees to share assets, liabilities and skills to start business. Like a single proprietorship, partnership is also simple to organize. Joint stock company. A joint stock companies are formed under company's ordinance and the legal rights to act as a person. It may be owned by a many person. A company has its own name, in which it can buy, own and sell property, make contracts, borrow money, and take court action. The person who have made investment in the company are known as shareholder. 3. Good or merchandise. In accounting, the word goods means something special purchased by the trader for resale purpose or anything which has been manufactured for selling purposes. 4. Purchases. In accounting, word purchases has a special meaning when saleable goods bought in a business, it is said that purchases. 5. Cash purchases. When purchases are made on cash, it is said cash purchases. 6. Credit purchases or purchases on account. When purchases are made but payment not paid on same time to the seller, it is said credit purchases or purchases on account. Payments are made on future dates in this case. 7. Purchases return or returns outwards. Goods once purchased may be sent back to seller due to some reasons like damage or below standard. Such returns of goods to the seller is known as purchase return or return to supplier or return outward. 8. Purchases discount and sales discount. The concession given by the supplier to the buyer on purchases of goods is known as purchase discount to the buyer and sales discount to the seller, supplier. 9. Allowances. Sometime the customers, buyers, finds that goods purchased have minor defects. In that case, maybe seller agree to reduce price of damaged or defective goods to induce the buyer to keep the goods. Such reductions in price is known as purchases allowance to the buyer and sales discount to the seller. 10. Sales. When goods are sold to customers at a specific price, it's said to be sales. 11. Cash sales. When goods are sold and received cash at the same time, it's known as cash sales. 12. Credit sales. When goods sold but payment not received at the same time but will received in future dates, it's known as credit sales or sales on account. 13. Sales return or returns inwards. If a customer to whom goods have been sold finds that the goods are defective, unsatisfactory, below the standard or not according to specifications, he may return these goods to the seller. Such returns of goods known as sale return to seller or return inwards or return from customers. 14. Trade discount. It is the deduction allowed by a trader on list price of a product given by the trader or seller to customers. For example, price of the book is $10 but book sold for $8, then $2 is trade discount. 15. Debtors or accounts receivable. Debtors are the persons or customers to whom goods have been sold on credit basis and from whom the business is to receive money in near future. The account of such customers are known as account receivable. 16. Creditors or accounts payable. Creditors are the persons or suppliers from whom goods have been purchased on credit basis and to whom the money is to be paid in near future. The account of such persons are known as account payable. 17. Cash discount. It is a deduction or allowance given by a creditor to a debtor if the amount due is paid by the debtor before the due date. 18. Capital or owner equity. Capital is the money or assets borrowed by the business unit from its owner to start the business. 19. Assets. Assets are things having certain value, owned by the business. Types of assets. Current assets. Current assets are those that exist in the form of cash or that can be quickly converted into cash. Fixed assets. These are permanent nature and used by business to generate income like building, machinery, etc. Tangible assets. These are assets which exists in physical form like building, furniture, etc. Intangible assets. These are the assets that have no physical existence like goodwill, patent rights, etc. 20. Liabilities. These are the amounts owing by the business to other persons and its owners.